You have figured out what investments you want to buy, but now you need to know when to buy and sell them. Today, we are covering the time-tested investment strategy known as dollar cost averaging, or DCA. The old adage is to buy low and sell high. The problem is determining what is low and what is high. Dollar cost averaging takes your emotions and guesswork out of the equation. Something to remember is the vast majority of people underperform the market. As in, they get worse results than simply buying one of the S&P 500 index funds and doing absolutely nothing. And this includes professional money managers and financial advisors. How does it work? You find good assets that you would like to invest in and buy at a predetermined time interval. Maybe you buy some every day, every week, every paycheck, etc. You take your emotions out of the equation. You don't stress constantly and worry about if you're getting a good deal. This allows you to statistically make better returns and spend way less time and energy on your investments. It really is the best of both worlds. You might be wondering, well, why does this work? Nobody knows what the market is going to do, especially in the short term. It is highly draining mentally and emotionally to constantly pay attention or worry about when to buy and sell. This is especially true if it isn't your full-time career. You also avoid taxable events if you don't sell. If you own an investment for less than a year in the US, the tax on your gains is 40%. The tax burden of moving in and out of investments often wipes away any extra gains that you might have made from timing things properly. The caveat is, you still should review your strategy every 3 to 4 months or so. You don't want to mindlessly invest in the same thing for 20 years as the landscape changes. However, this means you review your strategy every few months instead of constantly worrying. This allows you to stay on top of things when they genuinely change, but not be bogged down about reading every article, newsletter, and to make the exact perfect move. Because hint, you won't. So you buy regularly, but when should you sell an investment? This is something that only you can answer as an individual, based on your goals and reasons for buying and selling. From what I have seen, if you still think the asset is of high quality, don't sell. Even if you find something better and you feel the first asset is a little overpriced, you still have to remember a few things. The first is selling triggers a taxable event, and two, you don't know what's going to happen next. Now, maybe at a certain price you stop buying more and just keep what you have, or you set aside a portion to sell if something reaches a certain price, etc. But millions of investors have lost out on enormous sums of money because they sold an asset they still believed in over the long run, but just thought was high in the moment. If none of the fundamentals of the investment have changed, don't look at short-term price movements. Just DCA or possibly hold off on buying more and move to something else that you like that might look better as a bargain at the current price. While this wasn't financial advice and just some education on a certain type of investment strategy, DCA has many benefits. Typically, people make better investment decisions when they aren't constantly stressing, they have less anxiety in their life, and you have more time to do the things you really love. If you found this video informative, please like the video, subscribe to the channel, and have a good day.